Hello, this is Jim Landman in Kaufman Hall's Thought Leadership Group, and I'm pleased to welcome you to our Summer Rating Agency Update. We will be taking questions during today's webinar. Please enter any questions you have in the Q&A function on the webinar interface at any time during the webinar. Today's discussion will be moderated by Robert Turner and Lisa Goldstein. Robert is a Managing Director and leader of our Treasury and Capital Markets practice, and Lisa is a Senior Vice President in our Treasury and Capital Markets practice and Thought Leadership Group. I'll now turn the webinar over to Robert and Lisa to introduce our panelists.
Great. Good morning, Jim. Thank you. I want to say thank you to everybody for joining us today. We're especially pleased to have our distinguished colleagues with us again. Eva Bogarty, Associate Managing Director at Moody's, Susie Desai, Senior Director at S&P, and Kevin Holleran, Senior Director at Fitch. We started these quarterly webinars about 2.5 years ago with the outset of COVID. And 2.5 years later, the aftershocks continue. Our provider clients are facing staggering financial losses with unprecedented labor challenges. We're experiencing significant rises in interest rates and a tremendous amount of capital markets volatility. Undoubtedly clear that we continue to face a variety of complex challenges. And we'll discuss those today, including covenant management, ESG, and other interesting topics. With that, we're going to jump in. Eva, we're going to start with you, and we're going to go with an easy one first. Is a covenant breach an automatic downgrade event?
I don't think there are any easy questions right now in healthcare, but thank you and hello. So is it an automatic downgrade event? I think I'm going to give you the classic, I'll elaborate, but I'll first give you the classic rating agency response, which is it depends on several factors. I mean, and I would say, to do the positive first, we obviously look at all angles and we're not on a hairline trigger. It depends where the fundamentals are going in. It depends, on the story always. But largely depends on the covenant. Where is that? Where is the covenant contained? What are the accelerations? Is it an event of default? If the covenant is contained in a bank document, it's more likely to have immediate acceleration. If it's in an MTI, then it requires a % of bondholder votes, right? So you have a little bit more cushion there, a little more time, and that gives us a little bit more time to take a measured approach and evaluate. Obviously, if it's a material event or an event of default, then that could lead to rating pressure, certainly. A lot of the covenants we see have consultant call-ins or, a 2-year tail. First year is consultant call-in, and the next year is, if you miss it again, it's an event of default. And so those, as we see that first year of the call-in, then we can take a little bit more of a measured approach there and evaluate and keep kind of in regular touch with you all to make sure you're doing what you need to do to fix it, and we'll just keep a closer eye on it. But I would say the event of default is certainly often can lead to a downgrade, and I think the depth of that rating action will depend on where the rating is placed in the beginning, what the fundamentals are, what the plans are to resolve, and what the plans are coming out. So a bit of a long-winded answer, but lots of factors.
Yeah, well, we're going to throw everybody in the deep end of the pool right out of the gate.
Yeah.
Well, and so, a lot of discussion around labor cost these days. I guess, as a follow-on to your question, there's discussion about whether the labor challenges we're facing are temporary or not. Do you view the labor challenges we're facing as a temporary aberration? And maybe, if it takes years to solve the labor challenge, how does that play into your thinking?
Yeah, I mean, so certainly the spikes that we saw in labor in Q1 are a bit of an aberration in how dramatic they were and how severe they were, but it's becoming less so. I think we can all see that these last couple of years, the trend has been more labor. You know, I think last time we were on this call, that was what kept us all up at night, labor, labor, labor. We might add covenants in now. And so, you know, I do think on the covenant topic, this is, you know, not going to come down to us, the rating agencies, to decide whether, you know, it's going to come down to the bond documents and the legal and the conversations systems are having with legal and any sort of negotiations they can make on their bond documents. So as far as like related to covenants and downgrades, as far as, you know, if it takes years to solve, again, I think if it's related to covenants, that's going to depend on legal and bond documents. But, you know, certainly just broad brush, we expect labor to remain an issue. So we should all be counting on it taking years to solve. And, you know, the conversations we're trying to have are, you know, what are your strategies around it? And, you know, how are you budgeting around it? What sort of cushion are you allowing yourself? What are your levers?
All right, that's helpful. Susie, a question for you. It'd be helpful to have you talk about how you think about automatic acceleration provisions. Some bank documents have that, and I guess, you know, be interesting and helpful to have you help us understand your perspectives on this.
Sure. And hello, everyone. Nice to be here again. It feels like we can't catch a break here, but so as we're here talking about covenants now, but here we are. And I guess, you know, maybe just to start off, it's incredibly important, you know, when you have automatic acceleration because of a potential covenant, to start the discussions early with the bankers, with the trustees, whoever, you know, where those covenants are. Keep us posted, keep the rating agencies posted on how those discussions are progressing. We may have, you know, several check-ins as time is progressing, and really know your documents because an acceleration here may cause an acceleration over here too. So really kind of understand, and it's not always a consultant call in. It can be, you know, you hit something, it's in the events of default that it's now an acceleration. So I'll just start with that. And then it really depends on where we go on the credit rating, on how those conversations are going with the banks and the trustees. If there is potential acceleration and the discussions are not going favorably, you know, we may credit watch it. In some cases, if there's enough underlying credit noise that we think there's some changes fundamentally, we'll take it down and maybe keep a negative outlook or a credit watch on it. We've done that in the past. There was a credit that I'm thinking of that not during this period, but several years ago, there were ongoing discussions about a forbearance agreement not being extended. We credit watched it, we brought it down. Last year, we had a credit where they had a covenant violation, which could lead to acceleration, and they did not have a waiver. And, you know, they were just sort of hoping that nothing happened. That one was already in spec grade, but we took it down to CCC because there was just a lot of concerns on where, you know, what potential stress there could be because they had very little cash. And some very uneven operations that were accelerating in the wrong direction. To my knowledge, there has not been like full acceleration, at least that I'm aware of, but you know, it is in the documents. So we have to ask a lot of the questions and we want that frequent dialogue. So start early if you think it's gonna happen and keep us in the loop.
Yeah, right. Thank you, that's helpful, it really is. Kevin, your turn. You know, what's your perspective on hospitals and health systems that lean on investment income to make covenants or achieve budget?
Got it. Thanks. First and foremost, great to be here, and Robert, thanks for calling us all distinguished. You made my day today. Good to virtually be with everyone once again. So look, let me give you the best case scenario and compare it to that. We love to see credits that make a 3% operating margin, and then add on, you know, another 3%, I'm just making this up, in investment income. And you'll often see us even cite things that's great balance between operations and non-op, and that's a good, strong credit because they can kind of look at both levers that are accretive to them. That's the good side. So what you're asking is, well, what happens if you're making basically zero on your operations, and then you're making either 3 or 6% on just the income? And the answer is, all things being equal, if it's two credits side by side, the first one I described and the second one I described, they're going to be at least a notch off because basically you can't control your future. You're dependent on, if you will, the whims and the vagaries of the market. And don't get me wrong, for the last decade or so, it's been pretty good. It's been all right. But a year like 331, 630 numbers, the market's way down, you won't be making your coverage. So it goes into quality of earnings and what's in your control. And we think the same way, by the way, whether it's investment income or JV income, it's coming in below the line that you don't control. That's a non-quality, if you will, earning. You can't control, you can't influence. So we have to watch that very closely. I say that in general. There are a couple of credits that we all have and we all know that we sometimes refer to as balance sheet credits. And those are ones that their balance sheet is so big, so high that, look, some years everything is on the investment income or donations. Maybe it's a children's hospital. And whether they make coverage or not, based on that is kind of sort of secondary to the point. That one leg of the stool, the balance sheet is so large, it sort of dwarfs everything. But in general, A, it's not a good look. And then B, it really is sort of a weakness, fundamental weakness in the credit. If you can't control a book of business and make a profit on it, that's all you can control, quite frankly. So it's a little bit of a concern for us.
Yeah, absolutely. Susie, a question back for you. Sorry, there's some echo. Do you want hospitals and providers to call you if there's the potential for covenant concern before the breach? Maybe just talk about that and what do you want to hear from management?
Yes, call early and call often if there's a potential breach or a concern for a potential breach. I think it's good. It's obviously not good to have the covenant breach or potential covenant breach, but it's a good sign that management's being proactive and reaching out and managing the risk rather than having it happen to them and sort of just taking what comes. So definitely reach out. Definitely, it does show us some proactive nature. We've definitely seen it before. And tell us the plan. Like, tell us what you're doing. When are the discussions? What's the timeline? We want to hear what those discussions are like, what kind of negotiations are happening, and what is the indication coming from the banks or the trustee, wherever that covenant is coming, or that violation, potential breach is coming from. We may want to phone. I know I've tried in the past to kind of phone and touch base with the trustee certain times when things have gotten a little hairy. And we want to hear if there, what's the plan if there is acceleration, back to that previous question that we talked about, but also just kind of what are, there's a potential breach coming. Here are some things that we might be able to do to kind of offset that or, avoid it. And those things are also helpful to understand. So those are some of the few items that I think we'd want to hear from management. But like I said, call early and call often.
A lot of nodding from the others on the call. And I'd say in preparing for this conversation, a lot of discussion about sort of a willingness to engage early with your rating analyst. Eva, sometimes folks don't want to, right? So how do you respond to that, right? If they don't want to call and talk about this, what's your encouragement, or maybe just help us understand your perspective?
Sure. I think I'm going to credit Lisa with this. Phrase that we use often is we don't like surprises, and nor do our issuers, right? So we try very hard, never to surprise you all with a rating action out of the blue without talking to you first. And, we definitely appreciate that transparency on the flip side. And it's, a bit of a funny partnership we all have, but it is a bit of a partnership we have to notify the bond markets, and that's what we're doing. So it is our responsibility to do that. So, we really appreciate a heads up. It's certainly better for us to hear it from you all than from the market. It just speaks to strong governance. It can speak to financial resilience depending on what the plans are. And, we're not just reacting to the numbers on paper, it's the story. And we will, mostly try and take a measured and thoughtful approach and hear the story again and know what, just really helps us to know what management is doing, what management is planning. We can keep lots of things, everything confidential, and until we have to take a rating action. But, we really appreciate the call.
Yeah, That's great. We're going to switch topics in just a second. I guess before we do, is there anything that the group would like to add? No?
The only thing I jump in, we keep talking about us, right? Let us know, but let's also not forget your bondholders, right? So when you talk to us, one of the questions we will ask is, have you spoken to your bondholders? What are they saying? Are they in this for the long haul? Do you have a many bondholders or just one or two? What's your relationship like? So all of that communication, as Susie said, call early, call often, not just us, it's a whole lot of people, because it builds up at a fundamental level some trust and a trust issue. We're all in this together. We're here to report the news, and we want to make sure that that you guys can communicate it out as well too. So it's not all about us as much as we like to think so. It's your bondholders really ultimately who we want to know about.
Right.
And I think it does give you then a view into like what is this management team like, and what it, you know, our sort of general view of management. So it does also do that. The long haul.
Great. Yeah. Awesome. Thank you. All right, Lisa, I want to turn it over to you.
Sure. Thanks, Robert. Hello, everyone. Susie, that is a great jumping off point, speaking about management, because we want to spend some time today talking about ESG, environmental, social, and governance, and give everyone today an opportunity to talk about their firm's efforts on ESG, namely the effort of scoring on ESG. So, the main question is, you know, what is the intended purpose of ESG, either relevance scores or indicators? Why call it out, especially if ESG has historically been baked into debt ratings? So Kevin, let me start with you. Fitch was the first to roll out ESG scores. Go ahead and take some airtime and talk about ESG for Fitch.
Got it. So yeah, we did come out with ESG scores. We call them relevance scores. So they're not using the rating scale that we're all familiar with. They use a 1 through 5 scale, one being good, 5 being sort of bad. And they were really developed, as you say, just to be an additional service to investors. You're absolutely right. The E, the S, and the G, particularly the G, is something we've been talking about and factoring into ratings for years and decades. I submit to you, if you pick up an old report from 10 years ago, written by any of us here, you'll read sentences and statements and say, well, that's really, they're talking about governance there. And they're talking about they live on the coast and it floods a lot. All of that's E and S and G. So this is just an added level, if you will, of transparency on the ratings for investors that have like an ESG focus or a lens for their investment decisions. And you know, you haven't asked the question, but you sort of get into it. It's like, well, how is the buy side sort of using that?
Right.
And I'd say multifaceted answer, but at its simplest level, we've not yet seen a whole lot of pricing differential. So we do follow some, green bonds that go out and with the ESG scores out there and some that don't, and same long-term rating, short-term rating, and they're basically pricing about the same. I think this is a short-term piece. ESG is not a flash in the pan. ESG is not something that's going to go away in a few years. This will continue to grow, continue to blossom, if you will, as our efforts start to get a little bit more coordinated. And I don't mean coordinated like, hijinks coordinated, but as we all get used to sort of talking about ESG on our side of the house, your side of the house, how the investors look at it, we'll start to come up with a common language and a syntax that we're all familiar with and can hone down into. You'll start to see some pricing differentials, I think, going forward. So again, it's an added service. It kind of expands, if you will, the universe of investors, particularly if you're interested in purchasing and representing at your purpose these kind of bonds. And I think the other thing that we hear again is we're also kind of new at this, and we're also kind of learning the terminology. I don't know how long it took, officially for the rating scale to get adopted and everyone's used to it. But we hear a lot of times, investor A, investor B, we've got our own methodology. We've got their own things we want to learn to. And everyone's a little bit different. But I think over time, 2 years, 5 years, 10 years, pick a number, I don't know. We'll have a real common set of syntax that we'll use, and this will become part and parcel of a rating, basically, that you'll see. So rating and your ESG score is going to go together and provide a whole lot of information transparency.
Okay. Susie, let me give you some airtime too on S&P's ESG effort.
Yeah, so we have rolled out what's called ESG credit indicators in certain sectors. Do not have a timeline yet for our non-for-profit healthcare entities. Also, they're not actually scores, and they are actually indicators, and I'll explain that in a second. And like everyone, we've been discussing, the ESG credit factors through our paragraphs that I think a lot of our issuers have seen in a narrative form. Again, these are all the things that Kevin talked about that we've talked about in the past. You have higher governmental payers, you might have more exposure to labor unions, you're in hurricane territory or wildfire territory. And these are we focus on what's really relevant for the credit in those paragraphs related to ESG credit factors and potentially any kind of effects that might affect the ability to pay debt back, right? And so we have those discussions in that paragraph, potential mitigants to, what are you doing to offset this? Things have happened in the past, how's that, and so we try to illuminate that there. And as we get more visibility into certain things, particularly like on the, environmental factors, we will continue to build that in and write about it. The credit indicators, again, not a new area of analysis, but what they're doing is providing additional transparency on what we've already been incorporating through those credit factors that I just talked about. It's just another step along with the discussion in those paragraphs to enhance transparency with a simple, numerical scale to basically summarize the magnitude and relevance of those factors in the credit rating analysis. So again, not new, just providing more transparency, trying to provide more, how much is this impacting a credit rating? So for now, as I mentioned, we don't have a timeline for healthcare, so we'll continue to focus on that narrative discussion in our rationales and with the discussion with management as well, and just highlight those factors that we think are most material and are part of the credit that would affect the credit worthiness of an entity. So that's where we're at right now.
Okay. Eva, we're right in the middle of the Moody's rollout of your ESG scores. Go ahead and take the mic.
Sure. So a lot of what Kevin and Susie said relevant here too. I mean, we're all pretty much doing this for the same reason, which is transparency to investors. Everybody said it already, but ESG has been reflected in our ratings from day one, or from as long as it's been part of lexicon in the credit industry, right? And so we just began in the last month to roll out scores. We are doing it kind of one by one, trying to have conversations with everyone so everyone understands what their scores are, what the framework is, what their scores are, how they fit in within the framework. And I know there has been some confusion of like, oh, well, if it's already in the credit rating, why are you doing this? Or, why do you have a credit impact score? So, there is going to be some time, I think Kevin already said this, to learning the lexicon and learning, the framework. But, I guess I will just say broadly, we have a framework across E, S, and G, 5 scores underneath specific to each issuer that touches on the various risks under each section. And again, just as Susie said, these are things you're seeing pop up already in your write-ups, and this is just a numeric score to try and clarify it for the market. And then there is this credit impact score, which we'll get into in a bit, I guess.
Yeah. So let's go ahead and go there. So individual ESG scores, and then indeed something called a credit impact score. I don't know if CIS is the new acronym, but credit impact score, kind of an overarching. So what is that intended to relate to investors, a credit impact score about ESG?
Sure. So, this has been like the thrust of the conversation with lots of folks. It is intended to show how the risks we're already measuring on those 15 issuer profile scores, E, S, and G, under E, S, and G, how that is already flowing into the rating. And so, so it's already the rating is already being impacted by E, S, and G. So we're just trying to identify for you how much of an impact that is. And I think about it in terms of like Moody's scale of our ratings is we have 1 AA1 and no AAAs in our hospital profile portfolio, and that is really already reflecting the very high societal, the government payer risk, the demographic risks among healthcare. So, all of this already is, as we say, baked in. And so the credit impact score is just trying to show you how that is. And I guess I should have said in the beginning, like our scores are similar to Fitch. We are 1 through 5, 1 being positive, and those are very, very few and far between, because this is, just as our ratings are, a global scale. We're measuring, across everything that we rate. So obviously the positives where ESG risk is, or ESG is not a risk, but it's a positive, is very few and far between. So should have.
I think the word risk is key here, in that perhaps the original understanding or incorrect understanding was that ESG scores or indicators were like gold stars. Like if you had a great ESG strategy, as deemed by the rating agencies, you would get a high score, or a 1, if you will, in this case. But that's not the case. Is that correct? This is measuring risk of ESG.
That's correct. And I see Kevin wants to chat.
Yeah, I mean, Lisa, one way you might want to look at it is, like as we've all said, right, we've been encapsulating and incorporating this into our paragraphs, into our text throughout time. This is extracting that text for you, basically, and assigning a score to it. It makes it a lot easier to track over time changes in that. So I was a 3, I went to a 4. That's not something I want to be. I went from a 3, I went to a 2. That's where I want to be. So instead of having to read report after report, extract yourself, we're going to do it for you as an investor. That gives you a great ability to sort of track these things longitudinally and just make it sort of pop off the screen. So again, additional information for the investor, transparency, ease of use, ease of access. That's a lot of what we're going for here, but it's not an additive to the exactly gold star upgrade, oh, you scored a 4 downgrade. That's not how it's being utilized on our end. Think of it as information we're pulling out for you to make it faster out of that report.
Right.
And Kevin, since Fitch has had them out since 2019, have you changed a lot of the scores, or are these pretty steady, unlike, say, a bond rating?
So in general, for the sector, very steady, very stable. And when something goes wrong, let's just particularly talk about the governance scores, where we spend most of our time, to be very honest with you, focusing. The proverbial management, the C-suite's turned over 4 times in the last month. That's bad. But once that starts getting addressed and fixed, it changes pretty quickly, kind of reverts back to normal. And in a year and a half, something along those lines, that problem was identified, remedied, resolved. And you can't say, well, management keeps turning over, that's bad. They're solid, they're stable now. They're back to a 3 score, if you will, just to use that as a reference. So very little change. When it happens fast, and then it resolves itself pretty quickly too. But not a lot of examples. Again, very stable for the sector, very stable.
So
sorry. I mean, we've had this mentality, right, in our sector for years, right? We basically created, if you will, social investing, so this is DNA really for the healthcare sector. So to say, hey, we're good stewards of the assets we're given to, that we work in, we live in, of our people. Yes, all very obvious things. So you just don't see too much movement in it, Lisa.
So Kevin, just on that point, are you looking for, when credits present in update meetings or sale meetings, do you want slides on ESG? Do you want additional information on ESG if it's already been a part of the credit view?
I would say, yes and no, right? That's a classic answer. If something's changed, absolutely, we want to know about it. We want to highlight it. We want to talk about it. So again, we can relay that information on. And certainly, look, if it's not too much trouble, if you want to pull together some ESG slides and highlight what you're doing, we would love to see it. It gets down to that, there's only so many hours in a day and only so much time we have with management. And if nothing's changed, well, let's table or save that 20 minutes and focus on really what has changed or what's about to change. So I kind of defer back to, if you will, the issue or the amount of time, what's going on, and certainly any kind of deviation from the expected, plot line, if you will. We have to talk about anything else. We'd love to, as long as we can fit it into the schedule.
Yeah.
Susan, go ahead, Eva. Sorry, go ahead.
I guess I would just layer on that in terms of, what we would like to talk about is, to Kevin's example, if governance was an issue in the past, certainly we want to hear about what you're doing, not just who's in place now, but what the strategy is to, to deal with that culture or to, stabilize.
And I think, I know I would agree with what Kevin and Eva were talking about in terms of just when things are changing, when things have just keeping us, posted it when we're talking through our annual reviews and discussions. And, for things like the droughts and the wild, the flooding, we have a credit where they've had a number of floods over the last, increased number of flooding, right, over the last few years. We might want a little more there. Just like, what are you guys doing? What's the city doing? What's, to prevent this from happening? If it's dislocating people for an extended period of time, it's sort of causing operating volatility potentially. And, that could increase over time if that continues. So how are you guys thinking about that? So it's those kinds of questions that, if you happen to be in those areas, that we might want to know. But for all those factors, right, anything that's changing or that's really kind of significantly affecting, again, the credit profile and the credit risks, we want to hear about, ESG or otherwise.
Right. So great examples, floods, hurricanes. You want to hear about the risks, but also the mitigants, what they are doing besides, say, a plan on the shelf. Is that correct?
Yeah, and it's just, because reserves certainly help. Having the reserves, the insurance, obviously knowing how to operate through FEMA and all those things certainly are, are good things. But I think I've just seen, like, not it hasn't happened often, but there's a couple of credits where you just see a little bit more, like, not just the event itself, but some operating dislocation, like people leaving the area, right? And then it's like it causes some volatility there. And if you're already on a lighter credit rating, again, maybe you need more reserves than what you needed before to kind of offset some of that. So it's those kinds of discussions that we might be having. Again, it doesn't happen very often, and it's not anything new. It's just if it's happening a little more frequently, how are you thinking about it differently?
Kevin, let me just go back to you on one thought. You said Fitch rolled out your relevant scores 2019, right before the world changed. It sounds like you are not getting a lot of calls from the buy side, specifically on the ESG. If they call, they're calling about credit. Is that a fair statement?
It's a fair statement. Fair statement. It's usually credit. And like I say, we're really only highlighting to the negative, which is usually what generates the most phone calls. I can measure it in one hand, maybe two hands. And so it'd be a limited number of phone calls anyway. But it really is ultimately boils down to it's a credit thing, not an ESG thing. The credit thing drove the ESG thing, and that's what we're talking about.
Okay, got it.
Unless it's a credit thing, right? Like the governance could be a credit factor, right? Like that becomes the credit factor.
Right.
Or the labor strike that you're going through that's gone on a month has become now a credit. It is that's I think what we've all been saying is that it's part of our analysis.
Right.
Mm-hmm.
We may come back to this, but Robert, let me turn it back to you.
Okay, great. Kevin, let's talk about sort of the first quarter results for this year, January through March, and I guess as much as we can start to see second quarter as well. Staggering losses for a lot of folks, and a real departure from prior year performance. But we haven't seen yet an avalanche of downgrades, right? So how do you incorporate these losses into your rating analysis?
Yeah, sort of my first thought was, do we have to talk about the first quarter? I sound like my kids, right? Do we have to talk about bedtime? So I'm gonna give you a little bit of a long-winded answer. So in my simple mind, credit analysis is sort of the three legs of the stool. One leg is the market you operated in, your market presence, and do you have signature services? Are you a market maker or are you a price taker, sort of a thing? And that doesn't change quickly in any way, shape, or form, and you can almost always see it coming a mile away, a big competitor opening up, something like that. There's your balance sheet, and right now balance sheets are even still at really high levels, and up until very recently we're at all-time high levels. So you've got two legs of the stool that look great. I mean, for the most part, nothing changes in one, the balance sheet's good, and you can even ignore all the advanced and accelerated dollars. We strip all those out anyway. So you have one leg of the stool that's had a bad quarter, basically. And, I have almost daily calls, certainly weekly calls, right? I tell not only my team, but also people way above me say, we are not ignoring this. Let me tell you this. But when we do, we go into a meeting and we say, look, your 331 numbers were, I think the words were, staggering and avalanche, so you had a staggering avalanche of losses. Why? And, sometimes even before I can get that question out, the CFO or treasurer, whoever we're talking to, and let me tell you, Kevin, the quarter one losses were based exactly on labor because of Omicron sort of a thing. Okay, that's something we can look past and fix and rebound from, just like any bad quarter. I think it's going to be 2 bad quarters, by the way, like a strike, like a bad IT install, like, you name some of the events that we've seen, we've had bad quarters. It's a fixable, overcomable problem, if you will, because you can adapt, you can adjust to it. And let's ignore just for a minute the expenses, but things normalize and go away as levels come down, staffing dollars come down just for a second. If you tell me, that the leg of the stool got cut by this much, and eventually you're going to fix it, that's fine. Everyone sat on a stool, right? And they wobble a little bit when the leg's shorter than the other, but it doesn't fall over. Now, if you tell me quarter 1 was just the beginning and you're going to cut the leg from this to this, eventually it tumps over, right? And it falls over. And that's where you're going to start seeing rating downgrades. But certainly what we're always looking for in ratings is what we sometimes refer to as that natural resting place. Is this a bad quarter, a bad couple of quarters? Can we easily identify the culprit of the quarter? Can we rectify that, fix that by staffing optimally, getting through this sickness, that sort of thing? Or have you fundamentally reached a level where you no longer can produce the margin you used to? You can't fix it, you can't recover from it, or you can all of those things, but it's going to take years to do. Okay, then now we need to have a serious thought that one leg of the stool is permanently shorter. And do we need to say we got to cut the other 2 legs of the stool to level it off at a lower rating? That's the conversation that goes. Right now, you're right. No knee-jerk reactions, waiting to see where this goes. We are frequent users of the flash reports every month, and we keep watching, the losses month by month by month slowly attenuate. And we can't wait to see June's numbers, but we think it'll be, about break even, a little bit of loss, a little bit of positive, depending upon who you are. And that's the trend line we've been expecting. If there's an aberration to that, we'll panic, but that's certainly what we're expecting to see. So that's kind of how we're factoring it in. Again, I got to tell you, we are not ignoring it. Our pulse is right on this every single day. We talk about it as a team, talk about it as a group, and we're trying to see where that natural resting place is.
That's really helpful. Thank you. I know that's on everybody's mind. Susie, as we think about what systems are doing to respond to the increase in labor costs and taking action and putting together turnaround plans, talk about timing. How long do you want to? How long are you willing to wait, or do you want to see? How quickly do you want to see action? Is it 1 quarter? Is it 2 quarters? Does it take a year? Talk about the pace that you'd like to see in terms of how clients are addressing these challenges.
Yeah, and I guess it goes again to the classic answer of it depends on the credit and a bit of their story. And I'd agree with what Kevin's saying. We are, we know that first quarter was just a rough one, and what is that recovery looking like? And as we hear, about the second quarter, it's not a quick snapback, right? It's still, it's still we're definitely seeing some losses April, May still. Maybe not as extreme, but certainly not what we want at a particular rating level on an ongoing basis. So it depends on kind of where the rating is on the rating scale and how strong they are relative to where they are on that rating level in terms of how much time we might give for that turnaround plan to come into play. So if it's on the weaker end, they've got less reserves, they're already lower rated, and they, it may move a little bit quickly in terms of we want to see a quicker turnaround because things could move south very quickly. We recently, again, downgraded, this was a higher speculative grade credit, but weaker performance, not a lot of cushion, demand on potentially cash for a project that was coming up, it went down. That said, on our higher rated credits, we want them to, there's a reason they're AA or AA+. We want them to bounce back. We want them to not feel too much pressure. But it also, there again, depends on the financial cushion and also the enterprise cushion. Like, how much have they built up as an organization? How strong of an organization are they? So I think for those, we do give them some time. And I think, we have different AAs too. We have ones that are, they have a good enterprise profile, but maybe really, really strong financials that are really starting to weaken. We have other ones that maybe have a very, very strong enterprise profile, very good financials, obviously, but isn't, is also weakening, but maybe not as fast as this other one. And we may, take an outlook change, those ones that we think it could move, a little bit more quickly because it was sort of all based on the financials, and those are really getting under some pressure. So, on the healthier ones, we do want to try to take a longer view on that, especially if they've always produced really strong operating results year in, year out. They've always been very steady Eddie, and this is the time that they're crunching. It's just also then over time, as we see that, we want to see, like, is it starting to improve? Are you getting month-to-month traction? I think as we look at, the end of the year, we may still see a loss for those December 31 fiscal year ends, but if you can show us good improvement, like, that helps. That really helps to kind of, the credit story. So it's a little bit long-winded, but hopefully that gives a little perspective of how we're thinking about it.
No, that's great insight. Thank you. Eva, talk a little bit about the correlation. Are you seeing any between, hospitals with high governmental payers and how they're performing?
Yeah, great question. I think I think we're all looking for correlation out there in the Q1, Q2 results, because obviously the performance downturn did not necessarily depend on payer mix. It's across all payer mix types. And that correlation is so tried and true for us in healthcare, that that generally higher Medicare, Medicaid have lower operating cash flow margins or cushions to withstand higher labor costs, et cetera. So definitely looking out for that, and that's certainly the case in some areas. But I do think it's much more of a mixed bag, and what we've been seeing in the high government payer mix areas is it really depends on the economy, the local economy they're serving. So some of, like, just take Florida for instance, really strong socioeconomic factors has resulted in some systems doing just fine through Q1, Q2, despite some pressures. So it's hard. As I said in the very beginning, we're struggling on the correlation. I would say, some of the strategies we're seeing, I think Susie already referenced it, but certainly FEMA funds. We've seen some, trying to negotiate their commercial agreements. Certainly, a lot of talk on growing retail pharmacy business, benefiting certainly from 340B, actually opening these pharmacies. Depending on the state, higher Medicaid supplemental funding. That's a nice positive silver lining in states that have that. And we haven't stopped hearing about ambulatory expansion, certainly. So, a lot of trying to align across all elements, find that full continuum of care, hoping to kind of boost efficiencies and control expenses and grow. So
yeah.
Not a silver bullet, but lots of different things we're hearing.
Sure. Kevin, as you're talking with clients about budgeting, what are you hearing about volumes? Or is the thinking that volumes are going to return to 2019 levels or pre-COVID, or what are you seeing on that front?
Yeah, budgeting is getting, once again, more difficult. It used to be we got 5-year budgets, and we had COVID, and we said you get a pass, and they came back, and now it's kind of getting a pass again, because it's just very hard to predict volumes as well as your reimbursement. Eva mentioned a second ago, people asking for higher rates. It was just announced not long ago, like Rutland Regional is asking for almost a 20% increase from their regulators, and so does that go through or not? Very hard to put into a budget. But let's just talk about volumes for a second. I think there's becoming a realization that the volumes have not bounced back nearly as quickly as they did from prior surges. Like, it's made me snap my fingers. But after the first shutdown, the voluntary shutdown, so to speak, they bounced back instantaneously. There's a lot I thought that they wouldn't. They did. Even after Delta, they did. But they're not recovering really after COVID. It's much more drawn out for a whole variety of reasons, not the least of which people are just sort of sick of going to the hospital, talking about hospital. Things are self-resolving. We've lost some people, that sort of thing. But I think there's a realization that volumes are not going to come back to 2019 levels completely, and certainly not to, everyone expects growth, right? So what the levels might have been had COVID never happened, 2019 plus a little bit more. So I think that leaves you with a couple of things. One, we're starting to, almost every day see another system or another hospital announces layoffs, which, look, that blows my mind. Just a few weeks ago, we were like, I can't find a human being to come in. Now I'm laying people off or curtailing services. I'm getting out of peds, I'm getting out of OB, I'm shutting down this hospital. Kind of that mission versus margin discussion. So the pendulum, I think, is really swung. And for those organizations that have said, yeah, volumes aren't coming back, it's now time to right size your staffing to that volume level, your new level. So I expect you're going to see FTE cuts. You're going to see right sizing, curtailing of that. The other thing is, if you don't accept that or you refuse to accept that, the only way to get more volumes now is you're going to steal it. You have to, beat it out. With the exception again of those, high growth states. And I live in Texas, right? So Texas, Arizona, Florida, Georgia, some of those states where that rising tide floats all boats. They'll recover faster, easier, better, just because there's physically more people here, and they're coming all the time. And so if you just capture your little 10%, 11%, 12%, it's just going to keep going up in terms of volume. So easier for some, harder for others. But yeah, bottom line, I don't think the volumes are going to come back like 2019, and certainly not in the emergency room. That's been the one laggard that's been pretty much steady across the board. And I think that continues again, whole host of reasons we could talk about if you like.
Are you seeing clients willing to budget for improved financial performance, and to what degree are they willing to put a stake in the ground in that regard?
Yeah, right now, the classic answer, it depends. By far and away, most people are very gloomy on the rest of 2022. So, and 2023 is probably going to be less than 2022. So kind of like this is as good as it gets mantra. There are a handful of issuers out there. Some of them will surprise you. If you rattle off the names, didn't expect to see that, didn't see that coming, who are quite bullish on the future, not only about finishing up this year, but as we go forward. I'm going to be the survivor. I had a great, 331. I'm sitting on a load of cash. There's going to be a fire sale soon, and I'm going to cash in on that. And so there's a few folks that are out there that are, when you talk to them, you walk away going, everything's fine. And then you have another phone call and you go, oh, that's right. The world's falling apart. So it's a very tough predictor, but I think right now, caution, conservatism, reduced, all of those, that's what we're hearing. That's what we're seeing.
Yeah, great. All right, Lisa, you want to take back over?
Yeah, specifically on labor, let's talk about that. Labor. Susie, let me ask you, are you seeing any relief in any particular markets where it's just been exceptionally tough? And any predictions on how long it may take to kind of come out of this shortage of clinical and non-clinical that we're seeing?
Yeah. So on the labor, I mean, it's interesting on the labor front, because I think one thing I might add to, I think there are some hospitals, healthcare systems where the demand is there and you don't have the labor to push through the volumes, and people are exhausted and people are taking time off and those kinds of things. So some of that hopefully will shake itself out. But we do hear from certain provider or certain healthcare systems that the demand is here. We can't service it. And that's causing a lot of the decisions that Kevin was closing down things, because we just can't do it all. And those fixed costs are so high. So I think those conversations are starting to happen. In terms of like where it's, where it's tough is, I mean, anecdotally, again, there's always some ones that are, bucking the trend. And there are some credits that are bucking the trend. I mean, they did have positive performance, and you're just, we try to ask questions all over the place, like why? And I think some of it's cultural, right? Like it might be a pediatric hospital that's just, people come there, people want to be, there's a reason why they come there. They're not going to travel because they're there to take care of peds patients. And so that's just one example, but there are other pediatric where they buck the trend. I think the coasts seem a little bit more expensive for whatever reason. Again, there are aspects of parts of those coasts where it's not quite as bad, but it seems from, again, anecdotally, maybe a little bit harder there in terms of the labor front. And again, to the demographic questions, like Kevin mentioned, Texas, Florida, growing market, Arizona certainly helps to offset some of the pressure. But everyone, even those ones that are bucking the trend, are still having pressures, right? Nobody's walking away from this unscathed. Again, we talked to, in terms of like strategies and whatever, I think we've talked about the strategies. I don't think there's anything new in those in terms of labor. Signing bonuses, retention, doing your own pool, doing different care models, working at the top of your license, all these things that we've talked about, looking at educational opportunities, residency programs, those kinds of things for nursing. So I think those are the things that we're hearing about. And when you put that all together, is it going to be a year? Is it going to be 2 years? I mean, hopefully it starts to ease as more nurses come through the system, or, and staff come through the system. But it definitely seems like it's another, year and a half at least, and hopefully it starts to get less acute, in those outer years, but certainly a multi-year kind of pressure point.
Got it.
Lisa, can I piggyback on something Susie said? I think what will be fascinating, I think, going down the pipeline, so to speak, is there are plenty of issuers who sort of held a very tight line. we didn't give giant merit increases across the board, and then some, we ate it, if you will, on agency and overtime. And others that did, we basically raised everybody's pay by 20%, 30%. Well, for one, that's a temporary hit. For the other one, that's a permanent hit that's now in your P&L forever. And I think as we move forward, again, assuming volumes come back to some level, we don't have more surges, the nurse pool stays about the same or maybe grows, hopefully, you're going to see a differential between those two credits going forward and their optimism about the future. I took the one hit early. I'm more optimistic about the future versus, maybe I kept my nurses. I didn't take that one-time hit as bad, but now I've got a permanent increase in my expense base. And so there'll be a differential between those two, I think, credit qualities going forward.
Okay. So if there's a permanent increase in your expense structure, you've got to absorb it, work around it. What does that mean for future capital spending? Cash flow is going to decline. How will that translate? Are you seeing systems pull back or revisit their capital spending? Eva, let me throw it over to you.
How about a yes? Yeah, I mean, across the board, right? We see everything, but I definitely think, so you have those that are saying, wow, this was a really soft or, negative first half of the year. Let's just hold off on this project, reassess, move on forward. And then you have those who have, this was a really soft first year, but the only way we're going to, make it through this in the long run is to build out as planned and get those, for the new revenue down the line. So I think we definitely, I would say, from March to now, we have heard more along the lines of, let's just kind of assess, we put it off this long, let's just wait and see a little bit, but also 100%, move forward stories.
Okay, so you want to be competitive, keep your facilities up to date, watch that, say, average age of plant, but not chase a metric either,
Right.
The system.
Right.
Okay.
And, and make sure you're explaining why, or, that you're willing, if you're really going for it with the debt, that you're willing to understand that there might be some rating pressure around that, especially in these very soft times. But everybody's in it for the long run, right? So,
right.
For the right reasons.
Let's actually come back to cash and liquidity. We've touched on it, on ESG and cash can buy you time. Kevin, let me ask you, I know Fitch has been very focused on cash to debt, days cash on hand. Cash now seems to be going out the door, right? Medicare recouping its money, investment markets very wobbly. Will your perspective change relying on cash? How are you factoring in, lack of cash growth right now?
Yeah, so cash, in particular leverage, cash to debt, if you had to say what is, the single most important metric to Fitch's ratings, that would be it. Metric, right, that we can quantify. Days cash, not so much, because it really depends on size and scale and other things you've got in there, but never a bad thing to have, but cash to debt is it. Two clarifications. One, talk about the cash going out the door, the repayments. Since day one, and I think all three of us have done this, we've stripped that all out. That was a temporary loan. So it has never impacted any days cash on hand or cash to debt calculation. It's irrelevant to us that it's being paid back right now from an analytic standpoint because we never counted it anyway. That all being said, yes, I think when we finish our medians for the year, we're going to see probably that 12/31 time period as the top of the heap, right? But go back to the three legs of the stool and kind of the wave. This cash accretion wave has been multiple years. So very wide and very high, quite frankly. It's been rolling through it. So if we've just hit the top, metaphorically speaking, we have a long wave where that wave sort of finishes down, and we come back down to levels that are still pretty good, all things being equal compared to 5 years ago, 6 years ago, 7 years ago. It's still a pretty healthy balance sheet. I will probably have to strip the phrase that balance sheets are at all-time highs now out of my stuff, but it's still very healthy, still very tasty, as sometimes I like to say. You get back to that third leg of the stool, though. So your market hasn't changed. If your operating stool leg is cut by this, and now over time you start to see that days cash on hand, the balance sheet, start to get chipped away, which is what we worry about over the long term, yeah, you could have two now wobbly legs that take place, which could mean downgrades. Yes, I'm not going to lie to anybody here, but I still think we have a whole lot of cushion for a whole lot of issuers that we're just not going to get too bothered about it. Now, Susie was correct. You got some people who are hanging on by a prayer. They're at the final thing. You know, they're down to 70 days of cash on hand, and you know that's only because of some funny stuff with the numbers at the end. And yeah, they go down 10 more days, and we're going to say, you know, combined with the operations, and that was it. That's what triggered the bell. So it's not a blanket, you know, free pass, but for a lot of people that built up their cash, we tried really hard during that time period not to upgrade everybody and just sort of watch it. We had a lot of cushion left to sort of use through, but certainly over the next year or two, we'll start asking more and more questions. Nice enough that we can turn down the dial just a little bit on CapEx, as we were talking just about a second ago. And yeah, we waited a while. We'll wait till the market kind of cools off. No one wants to pull cash out of the market to deploy it when the market's down. So I think you will see a little bit of conservation mode as well too. So I just don't think it's gonna be that acute, quite frankly, Lisa.
Got it.
Yeah.
Okay. Thank you for clarifying that. In regards to sourcing of capital spending, Susie, seeing anything new out there? Rates are rising, as we know. Anything new regarding funding capital sources?
Just in terms of, fundraising, we're hearing, that's been going okay. We'll see, I guess if we go to a recession, that might move things around there. Maybe, monetization of assets and trying to sell, IP type of things that are in your portfolio. So looking for things, those are maybe some offshoots, but nothing material outside of, doing your debt, doing your loans, doing, or cash flow, right? Good old fashioned cash flow. So that's why we'll see maybe some titration back on, or some pullback on the capital spending. And probably depends a little bit of what's going on in your market too, like how much has been spent by other players. I mean, that might start to go to your profile if you're not able to spend right now and you don't have other sources of funds. So those are some of the, nothing new, but just I think looking looking underneath the cushion for all kinds of cash wherever you can find it.
I guess I would just add, I think I'm curious if everybody else has seen just a push back to variable rate. Whereas, for a while it had been, mostly fixed, and now we're seeing just that on the variable rate issuance.
I haven't seen it yet, but I expect it. Absolutely. Yeah. No one's really issuing the debt right now, but when it starts coming, I think we'll see a bit of a shift or a push more towards it. Yeah.
I think who is issuing, yes, there's been a couple of variable rates that's coming. So, yeah.
And we'll assume that folks remember all the lessons learned. Great debt, right? Very good, very good. We're coming up on time. Robert, let me kick it back over to you.
Boy, we have more questions than time. So we always get to this part where it's crunch time, I guess. Maybe one last question for each of you. Take us inside the rating committee. What are the top 3 items that get most of the airtime right now? And maybe Eva, we'll start with you.
Yeah, strategy, right? I think there's nothing, we've talked about budgeting and how budgeting is difficult. Q1, Q2 are difficult. What, how are you dealing? How is this, if we can't rely on these numbers, these aren't going to be the steady state. We don't have a super clear view of what the steady state is going to be, as we've discussed with budgeting. So, what is the strategy around this, around each leg of the stool, as Kevin would say, and how are they getting to stable? So I do think the strategy story is coming out really strongly now.
Susie, what about you?
I think it's, the labor and inflationary trends and how you're coming out of that. It's helpful to understand what you're expecting and why. Why is the big, if it's something against what everyone else is expecting, why is it going to get that much better so quickly? We're looking at capital plans and balance sheet flexibility and, overall strategy, strength of the enterprise profile certainly takes airtime as well, just kind of where you're still headed. And if there's any pivots that are happening because of the current situation.
Okay. Kevin, anything you'd add?
No, that really is it. The last thing I guess there's just to be candid, it's a little frustration, I think, during some committees. This was a business for the longest time that we could go in and sort of bank on the projections and understand what's going to happen. And there's still a lot of vagueness and ambiguity and uncertainty about the future. And I don't expect anyone to cry me a river, but it makes our jobs a lot harder. You know, what's going to happen next year? Well, you know, the issuer didn't know, wouldn't tell me. So here's my best assumption using my best analytics. And I'd stand by them, but certainly there's a ratcheted level of sort of anxiety, I think, with some of our outcomes, because it just doesn't feel as solid as it used to. So a little frustration, a little anxiety.
Sure. Well, listen, thank you each, and thank you to our attendees and guests. We really appreciate your taking the time to join us today. Jim, I'll turn it back over to you.
Thanks, Robert. This panel will be coming together again at our Healthcare Leadership Conference on October 20th and 21st at the Four Seasons in Chicago. There are both in-person and virtual attendance options this year, with registration information available on the Kaufman Hall website. Please note that the early bird registration discount for in-person attendees ends this Friday, July 15th. Also, you are receiving an email with a link to a recording of today's webinar within the next day or two. Thanks again for joining us, and have a great rest of your day.
Thank you.
Thanks, everybody.
Thank
Be
you.
good.
Bye-bye.
Stay safe. Take care.